Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
Hi, everybody. Welcome again to the REI Foundation Podcast with Jason and Peely. Today we have a very special guest, John Azar. John is... Hi there. So John is the owner of, with his brother, is the owner of Capstone Property Management. He and his brother have over 5,500 units. Is that correct, John?
We manage that much, but we don't. We own about a little over 4,000. Our management company, Capstone, which I'm not an owner of, just to clarify. I am a managing member of Mac Venture Partner, but not Capstone. Capstone is part of our company, but I'm not an owner of that company. And we do manage a little over 5,000 units, but that is through our management company, which is Capstone. Mac Venture Partners own about a little over 4,000, or now it's going to be about 4,300 with this recent acquisition.
Awesome. Wow. Well, before we start talking about your most recent acquisition, why don't we get to know a little bit about your background?
Yeah. So John, we always love to start with just get a little more context of how and why you got started in real estate.
Well, both my brother and I did not necessarily start out in real estate. My brother started out in technology. My brother, Tony Azar, who's the founder of the company, started out in launching a technology company back in the 80s when computers were first kind of getting proliferated, and grew that company to a about almost $100 million company. And then he sold it back in late 90s when the the crash happened, or the bubble bursted, and probably not at the best time, probably two or 3 years after where the company should have been sold, but it is what it is. You learn from your mistakes and failures and you move on. And then in 2002, 2003, opened a real estate company more focused on single family flips. So essentially the start in the real estate started out for him, started in single family flips from 2000, which he concentrated on from 2002, 2003 until about 2007. Accumulating at one point, 2006, 2007, had a portfolio of about 60 homes that was flipping in 1 year. So single family homes. And then seeing the turn in the market in 2007, got out of that end of it propitiously and went into multifamily. Bought our first apartment complex in 2007. For me, it was a kind of early on, it was a parallel track. Tony is my older brother, so he was, we always had an interesting relationships growing up. I worked for him. I think he fired me a couple of times in the past. maybe more than twice.
I don't think you've actually ever fired your brother.
Technically no, but
I think I may have quit a couple of times. He might fire me.
I think Ryan's quit a couple of times.
Yeah, that's generally how it goes. So we know that
some harsh words are exchanged. It's just how it is with brothers. But at the end of the day, we loved each other. We figured at some point we're going to come back together, and we did at some point later. But in the same time, we're having sort of parallel tracks. I was in finance and investments for a long time in Boston. I had my own real estate development consulting company after I left Morgan Stanley with some partners of mine that we did development consulting for large-scale mixed-use development. We had projects in Philadelphia, New York, London, and Miami, and Boston. And did that for a few years, and then in 2007, the market took a pooper in the bed, and we pretty much went to zilch as far as the project's concerned. So we had to get day jobs, and then in 2013, 2012, we sort of my brother and I realized that we could probably do better together and combine forces. And he was trying to tell me to come down and join that side of the business for a while. And like I said, it took me until 2013 to get convinced. And it took me another year after that to convince my wife to come down here.
So right now you're in North Carolina?
In North Carolina, in Charlotte. Yeah.
Amazing. But go ahead.
Well, you talk a lot, and I think it resonates, is that you have these setbacks, but you let these setbacks be growth parts, and maybe they sidetrack you, but you get yourself back on track and you find better ways and new ways. And that's a lot about the point here, is that you're going to have missteps in this business, especially in many businesses and every businesses. And you just let that derail you, or just the thought of it derail you. You really never get yourself going. And a lot of the listeners here, they're just trying to find their way to get themselves started. But they're always worried about what could possibly go wrong. So how have you basically set your mind that you have these things that catch you off track, but you right the ship and you move forward? Could you talk a little bit about that?
Yeah. First of all, anything and everything can go wrong, and you have to be sort of mentally prepared for that. And it's okay for things to go wrong, because unless you try, you're not going to know. I've had a couple of failed businesses. We tried it for a while. I did my development company. Had another consulting company that didn't go well. I had a stint in venture capital that didn't necessarily work out that well. So we learn from our failures, and we just have to sort of, as long as we're learning something, we take some tidbits out of what we're doing and try to improve the process, and kind of maybe truncate that delta of failure somehow or another. And the next time we do it, that will be that's great. I mean, that's the best you could hope for. And I think my brother Tony would say the same thing. I mean, unless you take that chance, you don't know what the reward will be. I've always been a huge fan of failure and kind of learning from failures, and learning to really having failure as a teaching tool, rather than just a lesson learned. In fact, I love failure so much, I'm giving a TED Talk about it in a couple of months. So it's
awesome. Do you know when the TED Talk is going to go live?
October 13th is when I'm doing the TED Talk. Yeah.
October 13th. I'm gonna write that on my calendar.
That's very cool. That's going to be very exciting. Yeah. Congratulations on that. And,
Thank you.
Failure. I mean, it is just it's such a topic, because people, I've done it myself. I find ways that I have the thought of something going wrong, talk me out of actually proceeding, but you have to take that hurdle. And you usually, when you get yourself to take that hurdle, you realize that even the failure that you were thinking of, you never actually have that bad of a failure, or it's always 10 times worse in your head than it actually happens. Even when it's at its worst, and a lot of times it's still in your mind, you still had it pictured worse. And so it's just getting over that hurdle, and that's incredible. So,
well, like for instance, I'm gonna be honest with you, I'm afraid to fail. And, I try my best, and I get down on myself every time, I have the setback. What would you tell people like me who sometimes don't take that first step because they're just too afraid?
Yeah. I mean, just go ahead, and what I would tell you and anybody else is go ahead and embrace the failure that you might have, or that might set you back. Just be mentally prepared for that. I mean, so as long as you know that you're going to have, just make sure you don't hurt yourself in doing it. I mean, if you have your health, there's a difference between failure or the fear of failure and real danger. Now, most of the time, most of us don't have to face real dangers. Thankfully, we're not going out there trying to dodge bullets. We're not going out there trying to, traverse a mountain that we might fall and actually, crack our neck. So these are real dangers. These are real dangers, and fear or caution of those dangers is warranted. But most of the dangers that most of us feel are really, almost mental dangers. They're not really, at the end of the day, they're not going to leave you maimed. They're not going to leave you, with some kind of physical malady. They might hurt your ego, but they're not going to leave you maimed. They might hurt your pocket also, but at the end of the day, if you have your health, you should be able to pick yourself back up and try again.
Great advice.
Yeah,
very good advice. It's really just a mindset. So talking about mindsets, so you guys were in the single family. You've done a whole bunch of different things in real estate. How did you switch your mindset to go into large multifamilies?
It's first of all, there's a few things that are related to multifamilies that makes them such a, for me and for my brother, we love that class or that asset class for investments. The safety is number one, both from an owner or sponsor perspective and from an investor perspective. The safety of multifamilies are, bar none, one of the best out there as far as the classes of real estate, classes of investments in general. I mean, I can compare and go against the beta of multifamily investments against any other class of investments, such as equity, stocks, bonds. I mean, that's my background. So every time I get in touch with, an investor and they try to talk to me about what the risk factors and the beta factors between real estate and stocks, I win that argument bar none. I mean, I love those arguments because it's not even an argument. I'm like, okay, well, this is not even a fair fight. It's like, you're bringing a knife to a gunfight. So it's
so have that argument.
Yeah, give us
argument with me right now.
Points. Yeah, we'd love to know some key points. If say Peely was saying that she wants to go out there and invest in a diversified portfolio in stocks, bonds, mutual funds, as a lot of people decide to start out investing.
Yeah, sure. Yeah, so the average, and these are something you can obviously fact check me on, but the average return of a like say a 20-year track in the stock market in the S&P or Dow Jones, the average return for an investor in that 20 years is going to be approaching anywhere between 10 to 12%, 13% returns. That's what average investors usually do in the stock market, and that in a stable market environment, meaning that you're going to have some ups and downs in the stock market. The same average returns for that in a multifamily setting, you would have probably turned your portfolio 3 to 4 times, but probably made close to 60% of your money, 60% returns on your money during that time. So, I mean, you don't have to be a rocket scientist to figure out that the difference between 15% average return and 60% average returns is a lot. Just on a return factor. It's just on the returns. Let's approach it from a safety or risk standpoint. Your beta on equities and bonds is high. It depends what you're investing in, what your appetite for, how aggressive you want to be. Your beta on equity is really high. Your beta on venture capital or private equity, if you want to be more adventurous, is going to be sky high. Your beta on multifamily real estate is about as low as you can get, because you're not only investing in a class that's backed by real assets. That's the first thing. It's also backed by a diversity of tenants. So you're not really investing in you're investing in an asset that has, let's say, an average of 200 tenants in it. Let's say 100 tenants in it. So you take an economic hit of 10%, 15%. So you lose maybe 15% of your tenants. You still have 85% occupancy, or 80 some percent occupancy. It's not that hard to make up the other 5 or 10%, get back up to the 90% occupancy. So, you're always going to have that stream of income that is diversified by the amount of tenants that you have in your property. So returns and safety, I mean, I don't know.
Done. No argument.
It's perfect. I'll send you the paperwork to sign soon. It's in the email.
I was just having this talk, and it was actually across different sizes of multifamily, where someone was investing in a 4-family, and he was telling me why we just had we just acquired a 94 unit and how the 94 unit was so much more risky than the 4 unit. And I said, well, actually, sure, maybe just based on size, you can, in your mind, you're thinking it's more risky. But now I have more economies of scale to my favor. I can hire staff that I can afford with the property. If I have one person move out, maybe I'm 3% vacant, 2% vacant. If you have one person move out, you're 25% vacant. And Now, if I go here and I try and get leverage, people are looking at an asset that's performing. It's performing based by the numbers, and you are having to get this based on your track record, your personal financials, and a lot of other points. And I'm trying to make it to the point where it's just all in the numbers. But as you add up the numbers, you have so many economies of scale that work in your favor that you really have to take a look at it.
Absolutely. Yeah, absolutely. The economies of scale are definitely is what helps in the multifamily. That goes back to what I just mentioned about the risk factor of diversification of tenants. You have a 3 or 4 family, like you said, one tenant move out and you take a 30% hit. 10 tenants move out of 100 units, you're still at 90% occupancy.
Yep.
Wow. Well, so since we're talking about sort of like the differences between the two, and there's a lot of investors that don't do the mind shift into large multifamilies because they can't handle it. We've actually been talking to a lot of single family investors that are just like, I don't know what to do. Like, how do you start? When do you start? Like, what books do I have to read? So what are some actionable steps that investors can take to get into this type of investing?
Yeah, I mean, the hurdle of buying the first large scale multifamily deal are real. These are not just psychological, because you do have to. There are money factors involved that you do have to secure. So yeah, it's not just the psychological hurdle point of actually getting to the first big multifamily deal. You need money. I mean, so at the end of the day, you have to secure your financing from a debt perspective, and you have to secure your financing from an equity perspective as well. So if you don't have the equity for your first deal, then you syndicate it, obviously, which is what we do with all our deals. But for your first deal, even if it's a small multifamily deal, let's call it 60, 70, 80 units, maybe it's, I don't know, let's call it $2 million. You can finance maybe up to 75% LTV or something like that. But so you can probably finance up to $1.5 million, $1.6 million, but you still have to come up with $300,000 or $400,000 out of your pocket. And if you don't have that, then that's a hurdle. So you have to syndicate that 20% or 25% equity slug to investors. Maybe your first deal, you do it, what I would call in the venture capital world, angel round, friends and family round. You just kind of go around and get friends and family funding, or somehow or another cobble together that 20% or 25% that you need. And that's why I advise sometimes keep your first deal smaller so it can be more manageable. It's don't look at it from, oh my God, I got to buy a 200 unit, or I got to buy 150 unit for my first deal to make it worthwhile. Mm-hmm. How do you eat a whale? Take one bite at a time. So just take it one step at a time, baby steps, and you'll get there.
Well, that's a great actionable step. Just put the word out there that this is what you're doing to your family and friends, and see if there's anybody interested. You never know. I mean, people are sitting on their 401ks and everything. And
I would love to know more. So I think the first multifamily investment was in 2007. Were you working with your brother at that time, or was that before you came onto the team?
I wasn't. This was purely my brother. I was not. I mean, it was he started that in 2007, buying a smaller, I believe our first deal was close to 90 units, 80 some units, 85 units. That was the first deal that he bought. So it's small. I mean, now we don't buy anything under 150 units, but it's just our minimum's 150 units.
So the first one you were actually involved with, what can you tell us? What did you remember about coming in there, and now you're buying an apartment building? Even though maybe your brother had put together that track, I'm sure you still had your learning curve as you jumped into the business. Yeah.
I mean, for me, the probably the due diligence process is something that I had to learn initially on, because you do have a lot of due diligence involved in buying a multifamily, more so than people think. If you want to buy it right, at least, which is what you should be doing in every transaction, because if you don't buy it right, you're really kind of missing out, and you're screwing yourself for the future. So we've, something my brother always says, if you buy it right, that's how you make your money. You make your money when you first buy. And he's right. It's, when we look at an asset, we have to figure out all the things that could go wrong and try to sort of contradict ourselves or prove ourselves wrong that they won't go wrong. But so in that process, the first asset that I was involved in was 150 unit asset, 148 unit asset in Greensboro, North Carolina, and the due diligence on it, we went and looked at it first when we're trying to size up the financing. Went back to the drawing board, did the numbers, did the breakdown of the underwriting, then went back again and looked at it a second time. We made the offer, and then when the offer was accepted during the due diligence period, and usually what we do with every deal, not just this deal, but with every deal, before we go to before our due diligence period is over and our money goes hard, and we have we do a unit inspection right before we go towards that sort of runway to closing. We do a unit by unit walkthrough, and we walk every single unit of the asset that we buy. And that was definitely a learning curve for me. Well, just purely from a fascination standpoint of actually having to walk 150 units, 145 units or so, and the human elements is more obviated when you do that, because these are real people that you're renting to. These are you're owning a community of lives, essentially.
Yeah.
So
I just think you're walking through 148 some lives.
Yeah, that's exactly right. You're walking through 148 lives. Families, kids, dogs, lots of dogs.
Lots of dogs. You touch on a really nice point about just the need to just buy right, and that's where it all starts. When we're right now, we're in this time where it's really hot. Things are overinflated. People are buying at crazy numbers, and to the point where you'll see people buying with the intention that 3 or 4 years out they'll be able to do whatever they're going to do to improve the value of the property. How do you find properties like maybe like the one you just closed on? How are you still finding value in a market like this?
Well, we're not. I mean, we sometimes we took a step back recently. Back in November, December, we decided strategically to step out of the market because we felt it was way too hot for us to sort of keep going and pushing and just buying it. We don't have the attitude of buy at all costs. Some people may, and some people could afford that. We can't. We don't want to. We have too good of a reputation with our investors to risk that at sort of a buy at all cost attitude. And we decided in November, December that we're going to take a step out of the market, and we did. We didn't buy again until just now. So this deal that we just closed on is our first deal in 2017, which is, we're now in almost August. So it's by this time last year, we had already probably closed on 5 deals. Wow. So in 2016 alone, we closed on almost 8 deals. So 7 deals. 2017, you're looking at like I said, we just closed on our first deal. So strategically, we made a decision consciously to kind of step out of the market and just kind of let the crazies duke it out between each other, and for us to kind of not be in it. But a lot of the market overheating, I think, is largely, I hate to say it, largely due to institutional players who their capital, their equity slugs are a lot cheaper than ours, meaning that our equity cost us more because our investors expect a lot more. So our investors' expectation for us, and for a lot of small to medium sized players, they want to get anywhere between 8 to 10% cash on cash per year. That's the expectation out there, and then beyond the cash on cash or pref rate, they're expecting their IRR to be in the realm of 20, maybe at the very least mid to upper teens. You have a lot of institutional players, a lot of funds, a lot of endowments that are their money tied to endowments or funds. Their capital is a lot cheaper. They'd be happy with 4%, 5% cash on cash, and maybe 9, 10% IRR. So therefore, their appetite for paying a lot more is much, much higher than us. And because we just can't afford that kind of cost of capital.
Yeah.
So.
Yeah.
Thank you for that explanation.
Yeah, that's great. And we've seen it. We're a much smaller track, but we just the same competition level where it just nothing makes sense. The numbers don't make sense. And to have that for us, we do the same thing when we syndicate. And the most important thing is that you are taking on other people's money. And that was one of the biggest things that I had to realize when we first started this, is that the most important thing is people are entrusting their investments with us to be able to do this. And the most important thing for us is the return of capital. And that really stands out. So it says a lot when you guys brought 8 deals last year. It sounds like you've been on a pretty big buying spree for the last couple of years. It must have been a pretty hard thing to do, to just turn off the faucet and just say, okay, we're going to sit there for a little bit. But that's incredible.
It was. And I mean, believe me, we stayed busy. We had a refinancing. We kind of recapped portion of our portfolio in the beginning of the year, about 5 assets recap deal that we did earlier this year. So we definitely stayed busy. We did not stay busy, but yeah, I mean, just to go back to your point about investor money and safeguarding and being sort of that fiduciary guard for your investors' money. A lot of times those bigger institutional guys and pension funds have a investment mandate that they have to actually deploy their assets or their capital at a certain amount of time too. It's not just the rate of the returns that their appetite has a lot more of a tolerance for. It's the deployment of capital. So a lot of times they have investment mandates say you have to deploy, $50 million or $100 million worth of capital by, August of the fiscal year. So they have to put the money out there, whether they want to or not, whether they get 4% returns, 2% returns on it, they have to put the money out there. Otherwise they'll lose their investment mandate from wherever they're getting their money from. So that's another reason why a lot of those bigger institutional guys are coming in and scooping up things that they would have never scooped up a couple of 2 or 3 years ago. I mean, through 2 or 3 years ago, a lot of the, second tier, third tier markets that we're playing in, some of the guys from LA and New York that are would have never looked at second tier, third tier markets, and that's 150, 160, 170 door portfolio. Now they're scooping them up all the time because their returns are there, because when they look at their markets, their home markets, whether it's West Coast to LA or New York, their cap rate is like 3%. Cap rate in Boston are below 3%. In New York, sometimes they're 1%. So they come to markets like the Southeast where we are, even Midwest, and they look at cap rates that are in the 6-7% range. And they're like, what?
They're like, yes, please.
Yeah, exactly.
That's crazy. How much more do you want?
Yeah, exactly.
Hold my wallet wider.
Exactly.
So when you get into these properties here, I guess on the standpoint, would I assume that Capstone, the management arm, manages all of your properties? Or
That's right. Yeah, Capstone manages all our property, aside from properties that we own that are not in our core market. We have some properties in Texas and we have some properties in Michigan that are not considered our core market, and these are managed by third-party managers. What
are some things on a more property level that you like to do right when you take over a property to ultimately just, is it based on property, or is there certain properties that you're always looking for the same kind of repositioning tools or tactics to take into each property?
When we take over each property, we created something a couple of years ago that we've been very thankful for creating, and it's called the transition team. We have a transition team created now, and we're trying to duplicate that for more. Our transition team is tasked with essentially taking over a property and kind of having no hiccups in integrating the property into our portfolio. So to help that kind of seamless integration, and without, because sometimes when you take over a property, you have to either let go of the staff or change management or change the work crew or change all this sometimes help. The integration of the property makes it a hurdle to get over. So sometimes it takes you two to 4 months to integrate a property. And sometimes you have to reallocate personnel out of your current properties or maybe your head office. And 2 or 3 years ago, we made a decision to go ahead and create what's called a transitional team. And their job is essentially just to go around, make sure that these new assets are being seamlessly integrated into our portfolio without having any lag time between. So truncate that learning curve for us to integrate the asset. We do better when we find an asset that the management staff is willing to work with us and continue to work with us, and we want to work with them. That's a perfect scenario for us. When we take over a property, the staff there is great. They're on board. They fit in the mold of the employees we want to keep. And that makes it much, much easier of a transition.
That's great.
Amazing. So let's sort of like, we're going to sort of still follow the same thought, but I want to go back to the fact that you kind of, you weren't acquiring more properties this year. You just acquired that one property. So in this year, like, what like significant impact is your business dealing with right now? Like growing your team? Like what did you do this year instead of like going into it and buying more properties? What did you do to grow your business?
So we focused more on internal structures, internal processes. Again, in the beginning of the year, we did their recap portfolio, recap transaction with 5 of our assets that gave us a little bit more liquid capital to sink back into the business. We kind of did a restructure inside. We had to make sure that we have the right personnel in place. We launched a fund. The fund itself took a long time to kind of structure and launch. And the fund itself just launched recently, about a month ago or so. We were finally ready to kind of go out and start going out into marketplace. I'm probably going to start traveling in September, October to start raising funds for it. So that took a while. And in order for that fund to really be impactful and for us to be sitting in front of capital sources that will take us seriously is to have the right internal structures. And that's what we had to kind of focus on the first few months of the year, is to make sure that our internal structures are right where we want them to be, and they are poised to be able to scale up to where we can. So that's what we took the first few months of the year. We really kind of took almost like a self-reflection and look into ourselves and kind of decided what we need to change internally in order to be ready for the next stage of growth.
That's great. Yeah, I'm sure I'd love to hear more about the fund, but that would be a whole nother show. So we'll save that for another one.
Yeah, no, we don't want to do that.
But in terms of yourself, just in real estate, because you've tackled a lot of businesses, you've found your successes. What is something that's happened real estate specific that maybe has been a setback, but it's turned out to be a huge learning experience for you?
Yeah, from a real estate standpoint, it's the setback is always the time. I mean, time is always something you underestimate for anything that it takes to get accomplished. You go into it obviously all wide-eyed and ready to take it on, and you think it's going to get done in 30 days, and it takes 3 months or 6 months or 9 months. For me, tempering that time expectations have been probably the biggest thing I've had to learn. I'm a person that likes to, if I get an idea, I want to get it done right then and there. If I have an actionable plan, I want to set it in place and let's get it done. And I want to start seeing results. And if I don't, I start to get frustrated and say, well, what am I doing wrong? What do I need to change? And that's something I had to temper, in the past couple of years is that I don't want to point to a specific project per se, but just in general, this business will demand more out of you, and it will take longer than you think it will. So just kind of temper your timing expectation. It's okay to have to go after things aggressively, but if things take longer, it's okay. And I'm still saying that to myself. Sometimes this is a current problem, not a past problem. This is a current issue that for my own self-reflection and growth. So,
I'm gonna make a plaque out of what you just said for both Jason and I, because sometimes we're such like you said, we put plans into action and we want results. We want results the next day. And sometimes we don't wait long enough for those results to happen, and we switch gears and the results never happen because the gears keep on switching. So that's great advice. Thank you. Thank you so much for that.
It's tough to do with people who are, have fast thinking, fast thoughts, or, it's almost like speaking to someone who talks very slow and who articulate their thoughts very slow. It's the same frustration where you're having a conversation with someone and you're already on their next sentence before they're finishing their first sentence. I'm like, okay, let's get it on. I already know your next thought. Why don't you just skip over the next thought and give me the spot after that? Because I already know what you're going to say.
That's incredible. I love it. Yeah.
Well, let's talk about switching gears. We're going to switch gears on you again. So what is your big why?
The big why?
Mm-hmm. What's your big why? Like, why do you do this? Why are you in real estate? Why big multifamilies? Why spend all this time working? Why?
Well, first of all, it doesn't feel like working for me. It's if you do something that you love and you're passionate about, it shouldn't feel like working. You get up in the morning, you do your thing, you come into your office or do whatever you need to do. It should feel like something that you're meant to do. Or I hate to say it sounds quirky, but it sounds like it should be something that when you wake up and you start doing it, it feels right. It feels like something that you're almost like the work of a priest or something. It feels like you're doing something right for your life and I don't want to say for humanity, but at the end of the day, you should have your work be impactful somehow or another. And for me, the business aspect itself is I want to grow a legacy for my family. I want to grow a legacy for the extended family. And I want to have a hand in that. We all want to have something to leave behind, whether it's the execution of the business or whether it's the actual monetary value of the business. But I'd like my son someday to have something to point to and say, my dad built this, or for him to maybe work on someday, if he wants to. But and I think the same for my brother. We're all trying to grow this business to be a legacy business. And a lot of business owners, I think, will say the same thing. They want to kind of leave something for the next generation.
Nice.
Yeah, that's great.
Generation after that.
Wow.
So in regards to now, right now you're doing the fund. So we have that in the immediate future is what you're growing to. Where do you see the business, your business with yourself, your brother, Mac, moving towards in the next 5 years? Where is a goal in that next 5 years that you see yourself looking to achieve?
So our next inflection point is going to be 10,000 units. So we're already at that inflection point of 5,000. We actually might surpass 5,000 next month because we're looking at a huge transaction now. So as far as ownership is concerned, so the next inflection point really for us is 10,000 units. And that's what I'm saying. The next 3 to 4 years, my goal is to get us to that 10,000 unit frame. And then onwards to the next inflection point, which is going to be probably 16, 17,000 units, something like that. My hope for the longer term, maybe 10 years from now, is for us to be a player that is owning and running about anywhere between 25 to 30,000 units. Whether we diversify into something else 5 years from now, and we may not wait 10 years. Maybe we can diversify into other living aspects of real estate, such as co-living, or maybe student housing. We're usually very meticulous and deliberate when we make a move into either a new market or a new asset class. And we take our time into exploring that asset class and seeing studying it really well before going into it. But co-living is really fascinating to me, but I just have to do a lot more homework on it before we kind of step into it.
What was it that you said? I missed it. Cool.
Co-living.
Co-living.
Yeah, co-living.
Yeah. Interesting.
I've seen write-ups on that. It kind of takes the idea of like extended family living, sort of like having the large space and like different people living in like one huge space. Is that what
it's like co-working. I mean, I'm sure you know the concept of co-working spaces.
Yes.
So same concept. It's more for communal living spaces.
Yes.
So you're offering more of a communal living space where the renters will share their common space with other renters in the area. So, but not necessarily from almost like a roommate situation.
Mm-hmm.
The whole building, or it usually works better for medium to high-rise buildings, because it doesn't work as well with garden-style apartments. It's hard to make a living situation out of. But it's a much better situation when you have mid to high-rise buildings. You have a situation where you're offering tenants, let's say on the same floor, maybe you have each floor will have its own common area, common kitchen, common living room, common whatever. They'll all still have their private bathrooms, but the living areas will be all common. So it kind of creates that communal living space. It works really well from what I've seen in major metro areas like Boston, New York, LA, San Francisco. San Francisco has a huge demand for co-living spaces now, simply because of the cost of real estate is so prohibitive for people to have, their own. So, and it's moving towards that sort of trend where humanity in general is looking for more sort of community interaction and community living. So I think it's going to move towards something a trend that is going to be more popular, 5 or 10 years from now.
Wow.
That's really, the more interesting thing is that so many people, especially younger generations, have moved such into a social media aspect where no one ever meets to talk. Everybody basically does everything over the internet in some different fashion. So now it's almost like we're taking a detour back, because people are realizing that everything is on the surface. No one's actually having these human interactions anymore. So I'm very curious to see the future of how that plays out, especially maybe if you can get a larger bedroom, larger areas where you're spending most of your time, and then the kitchen can be shared. And that's not really possibly the area that you're going to be spending most of your time. Then that actually could be a huge draw when you're paying $500 a square foot for some of these places Yeah,
absolutely. I mean, from an economic standpoint, I think it only works in certain settings, in certain major metro areas, and so you have to have the right demographics. You have to have you definitely have to do your study. You can't just take one of those buildings and pluck it down in the middle of, outskirts of Kansas and expect it to work. Maybe it will, but I don't know. But you definitely have to do a lot more due diligence on something like that.
Oh, that's great.
Awesome. So I also have like a little note down here. We have mutual friends, and I heard there's like an incredible story of how you came here from Syria as teenage boys with your father and your family. Can you tell us a little bit about that?
Sure. Yeah. My family is originally from Aleppo, Syria, and my brother is the first to come here. He came here when he was 18. And then a few years after that, about 9 years after that, myself and my father and mother moved to the States as well. My sisters are also in the States. And so it was a conscious decision by my father to move the family and kind of start sending different members. Right after the first civil war of Syria, and that occurred in the 1980s, we had a smaller civil war, than obviously much smaller than what was going on now. Only affected a few areas back then, but I think he read between the lines back then, and he had the foresight to say that this is no longer where we want to be, and no longer where I want to raise a family. So 87, the whole family moved to the United States. And
smart man.
yeah, I was 16 when I moved here. I didn't know the language, I didn't know English. I knew French and Arabic. And I was a senior in high school when I moved here.
Wow.
Yeah.
Talk about, we talk about things like barriers to entry and, all these like cool terms, real estate terms, but you had every reason just to kind of not be the man you are today, not follow your dreams. You didn't know English. Even that. And and this is for our listeners out there, like, take this to heart, like, get over the things that you're putting in front of you. And I'm talking to myself as well. And like, go for your dreams. Don't let setbacks, don't let things like you don't know the English language, take you from achieving your dreams, whether they're in real estate, whether they're just like getting a job tomorrow. Just go for your dreams. That's an amazing story.
Yeah. I think you have to embrace what is given in front of you also.
Yes.
So if you don't, I think it starts there. And I moved here, and my family moved me here, and I had to, whether I wanted it or not, however angst ridden I was as a teenager for being plucked out of my social netting at 16. Anybody who was 16, if you pluck them out of one city to another, or one high school to another, they'll probably hate their parents. And I was plucked into a whole different country. So it's, needless to say, my angst was definitely sky high. But I wanted to integrate. I wanted to embrace the American culture. I loved sort of the whole Americana experience, and I wanted to embrace it. And learning English was the first priority. Learning English right was the first priority, not just learning English, because if looking around, I figured if I learned English like all the other ESL students that I was surrounded with when I first moved here, that I wasn't going to get dates fast enough. So I had to switch and figure out what is the best way to learn English more effectively so I can get more dates. That was my motivation back then.
We usually wrap up the show with words to live by, but I think you just gave us some right there. So find the quickest route to get what you want. Right?
Hey man, motivation, we each have our motivation in different stages of life. That was back then, that was my motivation. So.
Well, John, this has been absolutely incredible. I've learned a ton.
Yeah, it's been amazing.
Hugely motivational. We look forward to hearing your TED Talk October 13th.
Yes.
Best of luck in
Thank you.
Next little while is getting out there, getting on the road, building your fund and everything else. And if people are looking to learn a little bit more about yourself, your company, where would be the best place for them to maybe look up a little more on you?
They can go to our website, maccvp.com, maccvp.com. They can find me on LinkedIn. They can find me on Twitter. They can find me on Instagram. Although the only thing they'll get on Instagram is my running photos. They're not going to get much business out of my Instagram feeds. So,
that's great.
And obviously my email is john@maccvp.com. You can always hit me up there as well.
Oh, thank you.
Well, thank you so much, John.
Yeah.
Well, this is Jason.
Very much, guys.
Thank you. This is Jason and Peely for the REI Foundation podcast. Thank you so much, John. We look forward to hearing more about all your adventures in real estate.
Thank you, guys.
Thank you.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.